So the inventory has fallen. It was shipped, as you know, from the LBMA into the COMEX, and there was a condition that required that to fly or boat silver from London to COMEX. Now that's reversed.
This whole market, both the gold and the silver, and with the silver backwardation, which means the current price is higher than the future price. Okay, this is putting a huge strain, because what's really happening in here is that the physical markets are overtaking the paper markets. And remember, in the US, that has primarily historically been a paper market, and they can create as much of that paper as they want to.
In this discussion, David Morgan and Lynette Zang shed light on the evolving power dynamic between the physical and paper markets in precious metals. For years, the U.S. has operated primarily through paper trading, creating contracts, futures, and derivatives that often outnumber the actual physical supply. But now, that long-standing imbalance is starting to shift dramatically. As inventory levels fall, silver is being physically transported from London's LBMA vaults to the COMEX in the U.S., a rare event that underscores the growing strain on supply. What once moved freely from London to New York to meet demand has now reversed. The situation is compounded by backwardation, where current spot prices exceed future prices, a strong signal that investors value immediate possession over promises of future delivery. This trend reveals a deeper issue. The physical market is overtaking the paper market. When buyers demand real metal instead of contracts, it puts immense pressure on a system built on leverage and assumptions. If this divergence continues, it could reshape the global pricing structure of gold and silver, grounding it more in physical scarcity than speculative paper flows. Stay informed, stay prepared, and don't forget to like, subscribe, and comment below with your take on this shift.
And so, yes, the London market is tightened substantially. The spreads are tight, but rates are down. The panic has subsided, at least for now. The underlying issue, a world running short of metal, a system built on paper claims, does remain. It's correcting.
The physical markets are taking over the paper markets. Now, I know what's happening in the paper markets today. Of course, everything is severely stretched. And right now, we are on risk on. But quite honestly, with the U.S. Treasuries, well, they aren't the unimpeachable safe harbor asset that they were once, well, at least that they appeared to be. And it's a phenomenon repeated across the bond markets all over the world. Those long-term bonds, we've talked about this quite a lot. And as you can see, the percentage of foreign officials' share of outstanding treasuries, we've talked about this over and over again, they've dropped from over, well, I think in 2008, we were at 45%, and now we're down to like 15%. Hence the stable coins to create a new false market. And what about gold? Well, global central bankers have been loading up on gold, and who knows more about what they're doing, about that devaluation trade. That's the central banker's job, is to devalue the currency, but to do it in a way that you don't notice. But now we're at the end.
Silver market is a derivatives market, but behind the derivatives market, there's these 1,000-ounce blocks of silver. They all weigh something different. Very few weigh exactly 1,000 troy ounces. There are usually rough pours somewhere around that. The exact amount of weight is stamped into those bars along with the serial number. So I digress to come back. So the worst of the squeeze appears to be behind us, at least temporarily. And the 29 million ounces that you quoted is accurate, and it's been shipped across the Atlantic. But here's the key.
Yeah.
That flow represents the market self-correcting, not a collapse. Arbitrage opportunities triggered by the price spread do exactly what they're supposed to do, and that's move metal from where it is not needed to where it is needed the most. Once that silver lands in London, the spread collapses, and that's precisely what we're seeing right here and right now. Now, the estimates of another 100 million or so to normalize the market could be overstated. Why? London doesn't need to rebuild inventories to that level. It just needs enough liquidity to settle the trades without the premiums exploding.
How silver protects your ability to buy the same goods and services over time. Gold actually expands it. And gold is outperforming every single fiat currency. Every single one of these, physical gold, physical silver, is outperforming and has been for a very long time, going all the way back to 2000.
In this segment, David Morgan and Lynette Zang explore the recent tightening in the London and COMEX silver markets, where the panic has momentarily eased, but the deeper issues remain unresolved. While spreads have narrowed and short-term calm has returned, the global shortage of physical metal still looms large. The discussion highlights how the physical markets are increasingly dominating the paper markets, signaling a fundamental change in how gold and silver are traded and valued. The U.S. Treasury market, once viewed as the safest asset in the world, is no longer untouchable. Foreign holdings of U.S. debt have fallen sharply since 2008, and trust in fiat systems continues to erode. Amid these shifts, central banks have been quietly hoarding gold, understanding its power to offset currency devaluation. At the same time, the silver market has been adjusting through natural arbitrage, metal moving from regions of surplus to areas of shortage. While the worst of the recent squeeze seems to have passed, this movement of roughly 29 million ounces of silver across the Atlantic shows the system rebalancing itself. Yet, the underlying message is clear. Physical ownership is reclaiming dominance over paper promises. Let's get into the interview.
So right now, they're at the extreme because people watch the markets go up, whether they're real estate or stocks or crypto or whatever it is, and they go, oh, that's good, that's good. But that's not the real trend. The real trend is the value of the currency going down. Having said that, when all of that inflation is burned out, so you have them going from here down to an undervaluation level, and we see who survives and what is exactly happening in there, well, if you have the gold, it holds your purchasing power intact. Actually, this is more accurate. It holds your purchasing power intact. And so then it will be time to exit some of this, and depending upon what we're looking at, whether it's rights or income producing real estate or even dividend paying stocks that have actually survived this, etc. Then we start to exit out of this and convert into those income producing assets when they are severely undervalued.
The silver market is the biggest market as far as discrepancy between the amount of paper that's thrown at the market and the amount of physical that exists. No other market in the commodities like cotton or cocoa or soybeans or whatever has that kind of a spread when you've got like 7 months worth of paper to clear the market. But silver's, I should say always, but for a very long time been like that. Which means, in my view, there's just way too much paper relative to the actual physical commodity. And purportedly, the exchange is supposed to kind of look at that stuff, but they seem to turn a blind eye to it.
In this discussion, David Morgan and Lynette Zang dive deep into what's really driving today's financial markets. Not the illusion of rising asset prices, but the steady decline in currency value. While investors cheer for record highs in stocks, real estate, and crypto, the underlying truth is that inflation is eroding the purchasing power of every dollar. As this inflationary cycle burns out, what follows is a massive revaluation when overinflated assets crash down to reality. Those who've held onto physical gold will find their wealth preserved, ready to pivot into undervalued income-producing assets like real estate or strong dividend-paying stocks once the dust settles. The silver market, however, tells an even more dramatic story. It remains the most distorted of all commodities, with mountains of paper silver traded compared to a fraction of real physical supply. This imbalance has persisted for years, and while regulators should oversee such discrepancies, it often goes unchecked, leaving physical holders as the true beneficiaries when the market finally corrects. In the end, when paper promises crumble, tangible assets like gold and silver will stand as the ultimate store of value. If you found this insight helpful, don't forget to like, subscribe, and comment below.